On January 3rd, 2023, Burton Malkiel, author and professor emeritus of economics at Princeton University, released a 50th anniversary edition of his book, The Investing Classic, A Random Walk Down Wall Street. Barron's has already declared this 13th edition a must-read, and Burton recently sat down to talk about the book with CPA attorney James Lange. Jim is the president of 3 interrelated companies, a retirement and estate planning law firm, a CPA firm, and a registered investment advisory firm. A prolific writer, Jim's retirement and estate planning strategies have been featured in the Wall Street Journal 36 times, and he's also authored 8 best-selling books. Jim is no stranger to interviewing financial luminaries. For many years, Jim hosted a weekly radio show and spoke with an array of experts, including Ed Slott, Roger Ibbotson, and even Jack Bogle himself. We hope you enjoy this insightful interview he did with one of the most acclaimed economists and investment experts of our time, Burton Malkiel.
In your 50th anniversary edition of A Random Walk Down Wall Street, you have an extended discussion and a number of stories of how greedy investors lost enormous amounts of money. And in that, you conclude the consistent losers in the market, from my personal experience, are those who are unable to resist being swept up in some kind of tulip bulb craze. It is an obvious danger, but one frequently ignored. Could you tell us a little bit about the, let's call it the tulip bulb craze, and what you fear will be a continued pattern of overly greedy investors?
Well, the tulip bulb craze is one of the most incredible historical stories that I know, and is about the first recorded, well-recorded bubble of asset prices in history. What had happened was that in Holland, a traveler had brought back from the Middle East some tulip bulbs, which were planted in Holland, and the Dutch really liked the flower. They thought this was wonderful, and tulips became quite popular in Holland. Remember now, the Dutch are known for being very careful spenders. These are people who were not ostentatious at all, and they always behaved that way. So what had happened was that apparently when one of the tulip bulbs got infected by a plant virus, the tulip that was then grown from it had a lot of variegated colors that the Dutch found particularly beautiful. And so what happened was, as the markets were selling tulip bulbs at very modest prices, those that had the virus were considered more beautiful, and they began to fetch a little higher price. So once it fetched a little higher price, some merchants got the idea, you know what, maybe I should buy an inventory of these things, hold them for a while, and then maybe they'll fetch an even higher price in the future. And so the prices of these virus-infested bulbs, which were called bazaars, began to rise really quite quickly. And people were noticing that, the price of these bazaars was going up, and it then followed through to regular tulip bulb prices. And so they were all going up, and it became a matter of conversation. If people went to the bar to have a beer, somebody would tell somebody else, gee, I made 100 guilders by buying and selling tulip bulbs. And of course, nothing makes one angrier than seeing a neighbor get rich. So they had to do it themselves. And what happened was the beginning of this absolutely incredible bubble in tulip bulb prices, where the prices kept rising and rising. It was at that point where options were invented, a way to sort of leverage your bet even more. And it turned out that the price of a single tulip bulb rose to the astronomical level that it was the price of a nobleman's castle. Well, what happens with any of these kinds of bubbles, at some point, somebody says, you know, is it really worth that kind of money for a single tulip bulb? I think I'm going to sell. And once the selling started, it continued into being an avalanche. What happened, and it was really like our situation in 1929, the government put out a statement that there was no reason for tulip bulbs to fall. And of course, that made them fall even further. And eventually, tulip bulbs were essentially worthless about the price, the relative price of tulip bulb today. And that story, and it wasn't just a story, I mean, it was actually something that happened, became the metaphor for any situation where asset prices started rising wildly, where people would tell their neighbors about how they got rich, how this got copied, how these stories, these memes, if you wish, got transmitted from person to person. And we normally say when there is a bubble in market prices that it's tulip time, referring to this tulip bulb craze. And so when .com stocks doubled and then doubled again and doubled again in the late 1990s, it was referred to as tulip time in the at the New York Stock Exchange. And when Bitcoin went from $50,000 to $60,000 to almost $70,000, people talked about buying tulip coins. So it was the first recorded major bubble, and it's been the metaphor for all kinds of bubbles that we've had in the future. And what's interesting is this idea that somebody you know is getting rich and can tell you a story, and the story spreads. And today we've got the internet, so stories can spread almost instantaneously. You didn't have to go to the neighborhood bar to talk about that. You didn't have to go to the golf club to realize that your golf partner had become rich through speculation in some asset price. It happens almost instantaneously now. And my guess is, human nature being what it is, that it will continue to happen in the future. And what is the case in all of these situations? That eventually the bubble pops. Eventually, things get down to true value. Yes, the markets make horrendous mistakes, but eventually true value will out. And the people who lose are the ones who get swept in at the end of some of these bubbles and then have themselves holding the deflated assets after the bubble pops. I've got so many friends who lost enormous amounts of money. I mean, we see it all the time. We read these pitiful stories about just recently with Sam Bankman-Fried and his Bitcoin, his crypto exchange, how people got swept up. This was the way to make our millions, and they end up just so much the poorer for it. Yes, you can be a millionaire even if you're poor, but you can be a millionaire slowly. You can get rich slowly. If you try to get rich fast, you're far more likely to end up at the bottom and losing your money. I've seen it so many times with people I know. We see it in the news even today with people like Sam Bankman-Fried. Avoid anybody who tells you it's easy to get rich fast. Don't listen to them. And when people call you on the telephone with deals, as the good lesson has put it, never buy anything from anyone who's out of breath.
Well, interestingly, you touched on, let's call it new standards of value away from some of the things like earnings per share that have been more traditionally used. And, you know, we see some things like things being measured by the number of hits on YouTube or other types of quote value. And how has that worked out for investors? Are there new standards of value that we can replace with some of the classic ones that you use and talk about?
I don't think so. And I think the dot-com bubble is a perfect example of how we used other measures of value and it led people to disaster. What we would use, there's a wonderful one called Mindshare. What you would do is you would not look at the price earnings multiple of this internet stock. You would look at how many people were actually watching their ads on the internet and how much time they were spending. So you got valuation metrics of that sort, of how much time someone was, say, watching real estate ads. You weren't measuring whether they were forking out money to buy the real estate. You weren't measuring anything like that, and it led people to disaster because, in fact, and this is one of the things that I've tried to do in the book is talk about what are the rules of valuation. Any asset, whatever it is, its worth has to be the present discounted value of the cash flows that it is likely to earn in the future and be able to be distributed back to investors. I don't think there is anything else. That's the traditional measure of value. It has, there have been lots of people who've said, oh, that's old-fashioned. It's not old-fashioned. And eventually the markets do come back to valuing assets in terms of earnings and cash flow. And that's how I believe everybody should think about how an asset is valued, whether it's a common stock, whether it's a piece of real estate that you buy, or anything else.
So if we take earnings per share, that tends to be more of a historic measure. And I think in your book, you talk about a drug company that comes up with a new cure or a new treatment that is very valuable that might not have been reflected in prior financial statements, but might be very valuable. Are you still saying, well, we can value that because we can try to estimate what the sales will be, what the costs will be, and that's still a valid use of discounted present value cash flow?
Well, you raise what is a difficulty in valuing stocks, and that stocks really depend on what will happen in the future. I think now there may be one of the Dow Jones 30, I may have my years a little wrong, but only one of the original Dow Jones Industrial Average stocks that are still there. Eastern Buggy Whip Company does not exist anymore. And recently, even the granddaddy of all stocks, General Electric, was removed from the Dow Jones Industrial Average. So you're absolutely right that it's really not the past, it's the future. And the past is only useful in that it gives you perhaps some idea about the future. So I would say you're absolutely right. You can't simply use the past. It's the future that's important. But if you are trying to estimate whether a company is going to produce the earnings and the cash flow in the future, certainly you can feel a little more confident if you know that you've had a management that has been able to do it in the past. And again, this was in recent years. This was the problem with the so-called ARC Innovation Fund that was popularized by Cathie Wood, that these were people who had all these wonderful technologies. There were all these new metrics of value, but they never had earned a penny. Those tend to be far more dangerous. So yes, it's the future, but I want to bet on the future with companies that I know have at least demonstrated that they could run a business and run a profitable business in the past.
Up to now, you've given us some, and in the first basically 3 sections of your book, you have a lot of concepts that I think are critical for investors. But then when you get to section 4, you get to some pretty hard-nosed practical advice, specific advice, and things like that. And one of the things that you started with, which was a famous chart by Jeremy Siegel, is that Jeremy analyzed if you bought a common stock for $1 back in 1804 or 1802, that you would have $54 million today. But if you bought gold for $1, that you would only have $94 today. What are some of the practical implications for that for investors who like to, let's say, hedge with gold or other precious metals?
Well, first of all, I think the lesson is, and it is the basic advice in my book, particularly for young people, that common stocks have demonstrated their ability to grow, their ability to outpace inflation, and the common stocks should be the core of a person's investment portfolio. So what I take from that chart is, and again, it gets back to just our previous discussion of the past won't guarantee you the future, but boy, if I'm thinking of my portfolio as between gold and common stocks, I am comforted by the fact that common stocks, which basically represent all of the businesses of the US economy, and if I am a bull on the United States of America, which I am, I say this should be the core of my portfolio. Now, gold has been touted as a good inflation hedge. Gold has been an inflation hedge. And if somebody insisted on having a bit of their portfolio in gold, you know, I wouldn't fault them for it. But do I think that gold, even in an inflationary environment, should be a major part of one's portfolio? No, I don't think so. It is not demonstrated that it would be better than common stocks over the long run. And I don't think it will be over the future. And while you mentioned gold, I think it's the same thing for collectibles. And again, we were talking about bubbles before. These so-called NFTs, non-fungible tokens. You've got non-fungible tokens of baseball cards now selling for astronomical prices. This is one of the bubbles going on right now as we speak. Yeah, these are the things you want to avoid. These are the things that will get you into trouble.
Well, that relates to the next issue, which you bring up, and you very generously give other people credit for different ideas. And you gave one of your colleagues, Roger Ibbotson, who I've also had the pleasure of interviewing multiple times, a wonderful gentleman. And Roger said that 90% of an investor's total return is based on asset allocation, presumably between stocks and bonds, and then some of the variations within that. Do you believe that that was true, and do you still believe that that is true now?
I believe it is absolutely true. And again, that wonderful chart of Jeremy Siegel's, and Jeremy Siegel has this in the book that has the thesis that stocks are the thing to have for the long run. And there's no question about the fact that even if you had an actively managed fund and you had actively managed bond funds and you had actively managed commodity funds and you had all kinds of other assets and collectibles, the return that you would receive is largely determined by the proportion that you had in the better performing asset class, and that better performing asset class is a diversified portfolio of common stocks.
Will you actually make some very specific asset allocation recommendations and even fund recommendations on page 366 to 367 to your book? And it is based on age. is that what you consider a reasonable starting point? And then people might adjust based on their own circumstances, their own investment horizon, their own goals, et cetera?
Absolutely, but it is only a starting point. That if you are in a fortunate position to having saved regularly, to having enough to live on now without dipping into your capital, and you're investing for your children and your grandchildren, you use the age of the people you're investing for rather than your own age. On the other hand, if you have saved all your life, you put it into, and you've got a regular IRA, and you are required to take minimum distributions, you need a portfolio with a substantial part of it that will be in assets that will not fluctuate with the stock market. You don't want to be dollar cost averaging on the way out, because you'll then have a year like 2022 when the market went down, and you'll be selling more shares at low prices and really hurting your returns. So what I recommend people do if they are going to be spending that amount that they accumulated, or they will have to be because it's a required minimum distribution, that portion that's going to be taken out, that be in limited duration fixed income, not to maximize return, but to ensure that the money can be taken out without a loss. And the way that I suggest that one does this is, first of all, for the young people starting off with a broad-based index fund, I want them not only to put the $100 a month in, I want them to reinvest their dividends, which is an additional way of making the final amount be significant. But for people who get into their 60s and 70s, to the extent that they know that they are going to have to be taking that money out, I want them to gradually move into limited duration fixed income, where their dividends from the common stock are being put into the fixed income as well. And incidentally, you can rebalance your portfolio very nicely by having, you don't necessarily have to sell stuff. You just make sure the dividends then go into this. And again, it's obviously then, it so depends on one's individual circumstances. And so what I'm talking about when I say I want you to have some limited fixed income, it's for the people who will be taking their money out of their accumulated savings, not for the people who have it completely invested for their children and grandchildren and maybe even great-grandchildren.
Hi, we're giving you an exclusive opportunity to receive a free book. That's right. If you purchase a digital or hardcover copy of A Random Walk Down Wall Street 50th Anniversary Edition by Burton Malkiel, we'll send you a free digital copy of James Lange's forthcoming book, Retire Secure for Professors. It's a wonderful book for professors, university staff, or anyone who has significant funds in their IRAs and retirement plans. And it features a foreword written by none other than Burton Malkiel himself. Just purchase your copy of A Random Walk from Amazon.com, Barnes & Noble, IndieBound, or one of the other many booksellers where it's available for purchase. And then visit paytaxeslater.com/random walk and complete the form to receive your free digital copy of Retire Secure for Professors. And as an additional bonus, The first 100 people to purchase either the ebook or the hardcover edition of A Random Walk and complete our form will also receive a free hardcover edition of Retire Secure for Professors as soon as it's available in print.
So how would it, what would the impact if somebody had a regular fixed income, such as Social Security or a pension? So let's assume for discussion's sake that a married couple had a Social Security income of, say, $50,000. How would that impact your advice on the asset allocation? Or is that one of those where it depends on each case?
Well, let's talk about Social Security for a moment, because for particularly people of modest means, Social Security is really a very large part of their asset allocation. And let me argue with you because you had mentioned that it was fixed income, and it's guaranteed income, but the beauty of Social Security is that it's probably the best asset that you could possibly have, because it is guaranteed by the government and it is inflation indexed. And as you know, everyone on Social Security in 2023 is going to get not a fixed amount of income, but an amount of income that will grow by the inflation rate. And so this is bumped up with a high single-digit rate, and it is a wonderful investment in that it is not fixed. And since we're talking about Social Security, let's now talk about another part of the asset allocation for older people, and that is, to the extent that they have fixed income, I would like to have some of that fixed income be in inflation indexed bonds, particularly because I worry that there's a fair chance that we will not go down and eliminate inflation very quickly, as the Federal Reserve is trying to do. I think inflation is going to be far stickier. And so I want as much as possible in my portfolio, even if I have fixed income, to have some fixed income that will have some inflation protection. And while we're on the subject, I want to mention, because I think if your listeners don't know about it, they certainly should. And it's, again, one of the changes that I have in the 50th anniversary edition that I talk about, and that is so-called US Treasury I-bonds. And what this is a bond that you can buy issued by the US Treasury. A lot of people remember US savings bonds that have a fixed rate. This is a bond that you can buy that has a variable rate depending upon the rate of inflation. You can buy them today at a high single-digit rate. It's perfectly safe. It's guaranteed by the government. It is an inflation hedge. You can buy $10,000 a year. You can buy an additional $5,000 if you have a refund coming from the IRS. And this is another asset that should be in the portfolios, particularly of older Americans, particularly those who then don't want the fluctuations of common stocks, but still want some inflation protection. So again, you know, there's a menu of alternatives. The reason I put in section 4 is, sure, it's easy to say in accumulation phase, just buy a broad-based index fund. But then when you get older and you're thinking of taking some money out and you need inflation protection, there are a lot of different instruments. You need to understand what they are and how they can give you both safety and inflation protection.
Well, one of the things that I think was so wonderful about that section is it is so specific. And I think unlike, for example, recommending, say, actively traded stocks that are going to fluctuate maybe with just the change of a manager, because these are broad-based indexes, that they would have, let's say, less change compared to other investments, so that it's giving the advice a longer life, if you will. So I just thought that was wonderful. And it was kind of a formula for people, at least, again, as you say, as a starting point.
Yep.
So why don't we go to one of your favorite areas to attack? And I'm in perfect agreement with you on that. But you make a really strong case against commercial annuities. And that's sometimes very attractive to people because they think, well, I'm willing to take a little bit of a haircut on the upside, but I want protection from the downside. And the annuity salesman, although they don't call themselves annuity salesmen, they call themselves maybe even financial advisors, are recommending this as something that is good for people who are older because it has a downside guarantee. Why are you so against some of these commercial annuities?
Well, again, it goes back to one of the major lessons in investing. And I think I've done this in a previous session of quoting my friend Jack Bogle, the late Jack Bogle, that in investing, you get what you don't pay for. And the problem with annuities is they have some advantages. There's no question about it. And they give people some protection. But by the time you pay the fees of the salespeople, and they are salespeople who sell these things to you, that so much of the return is actually taken up with fees that, in fact, they're not good investments. The idea of an annuity is a fine thing, and some people need some protection, but most annuities are horrible investments because implicit in them is very, very high fees. And if there's sort of another regular lesson of investing, for heaven's sakes, watch the fees. So what would I suggest that people do? I can certainly understand the attraction. If you do want to annuitize some part of your retirement savings, be a careful consumer. Buy them from somebody like a Vanguard, like a TIAA-CREF. Do it where there will be minimal fees, but for the general person who is calling you up and trying to sell you an annuity, I can almost guarantee you it'll be such a bad investment because all the benefits will be taken up by the fees they charge.
And what about immediate annuities, where you in effect give the insurance company a chunk of money now in return for an income stream, and it could be with or without inflation, and there's a number of let's call it ways that they can pay you back. But are you a fan at all of immediate annuities?
No, because I think the same fee argument holds. And I actually have some figures in the book. Since I'm worried about inflation, I want the ones that have some inflation protection. And the fees are so high that the amounts you get are just not nearly what you would have by buying directly an inflation index treasury bond, by buying these I bonds that I've talked about. I really think you'd be much better off doing it yourself. And as I say, I do want you to have some inflation protection, even if you've got some fixed income and some real safety, and you can do it with inflation index bonds.
Well, you also mentioned that you'd be a little bit more, I'd say, open-minded to some type of immediate annuity with Vanguard and TIAA-CREF. And I'm going to use the example of my own mother, who was a college professor. Back then, they had mandatory retirement at age 70. And back then, you didn't have all the options. You had to, in effect, annuitize. And you got a certain income that was more or less guaranteed on the bond portion, which was the TIAA. And then you got a portion that went up and down with the market for your CREF. So she never had a lot of money, but she had a regular income for the rest of her life. That is probably relatively out of fashion today. Do you see a role in that type of thinking, perhaps with a Vanguard or a TIAA-CREF? Of course, TIAA-CREF has changed also. But is there some role for somebody who is, and then there's something called a QLAC where you don't get the income now, but you get it later, again, presumably with lower fees. Is there a place for this, or are you still too worried about the fees, even with, say, TIAA-CREF or Vanguard?
You raise an interesting question, and interestingly enough, I have this kind of annuity myself, because my own university, in its wasn't universities have what's called a 403B plan, not a 401k plan, and our plan made us annuitize some portion of it. And I am getting regular payments from TIAA-CREF, so I understand exactly what you're talking about. And it's kind of interesting that your view about this, and my view about this, has changed a little bit with age, and I'm more sympathetic to the comment that you're making. And I do say that it's fine if you have a portion that's annuitized if you can get it at a low fee. I remember when I was a young assistant professor, I was kind of the person on the faculty who knew something about finance. And I was importuned by other professors who were very upset about the requirement of our university that we had to take those savings and annuitize them. And I remember some senior professors who were importuning me to try to see if I could help get it changed, said, look, I want to leave my high tax state of New Jersey, buy a modest apartment in Florida, and I can't, the money I want to do this with is my accumulated savings, and the university won't let me do this because it has to be annuitized. And I remember going to the dean of the faculty and making that argument. The dean of the faculty looked at me sternly and said, no, we will not do that, because the last thing in the world we want at Princeton University is to have our senior retired faculty members running around Princeton with ragged clothes and practically starving because they spent their money unwisely. And at the time, as someone in my early 30s, I thought, what a silly argument. On the other hand, I have a little more sympathy for it, knowing so many older people now. And there was something to this, and the good part of the TIAA-CREF annuities were that they tended to be low cost. Now, I am less attracted to TIAA-CREF today because it used to be essentially run as a nonprofit with very low expenses. Today, it is owned by Nuveen, and it is a profit-making company, and it has, in my view, quite unconscionable expenses. Their broad-based index fund charges 40 basis points, by which I mean 0.4%, whereas the Vanguard funds are 2 and 3 basis points, essentially zero. So I'm not as happy with TIAA-CREF as I might be, because the fees are too high, but I do understand the argument, and there are certainly some advantages of annuitizing a part of one's retirement, particularly if you need the discipline of not being able to spend all of your money, or as that dean of the faculty told me, you don't know how bad these old Princeton professors are. They'll just waste the money, they'll be impoverished, and everyone will say, what a terrible university to let their retired people be in such dire straits.
Well, the other thing is you have wisely listened to the advice of the great French writer Voltaire, who said that if you annuitize, he recommends that you survive, if for no other reason to enrage those who are paying your annuities. So good job. You've done very well, as my mother did. So, for example, no other investment really could have given her a guaranteed income until between 70 and 95.
Oh, no, absolutely. But again, just to make sure that people realize there's another disadvantage, and that is, let's say you have a retired couple, they annuitize, and they both find that they have been diagnosed with an incurable illness, and that they have been told by their doctor they've got 1 year to live. Well, maybe they'd like to take that trip around the world. Maybe they would like, that you lose some flexibility that way. And all I'm saying is, life is complicated, and some of these decisions are complicated, and just realize you're also, by gaining that advantage of never being able to outlive your money, you're giving up some flexibility.
Well, so let's talk about maybe the future. And you actually said that no one can accurately predict short-term returns. And you don't seem all that optimistic in terms of either the bonds or common stocks doing as well as they have, say, for the next 10 years as they might have done in the last 20 years. And I'm not going to try to ask you to be a forecaster, because I know that you don't like that. But do you have some type of expectation that maybe we shouldn't be as exuberant with our expectations as we have been in the past?
Yes, I do. And I do for the following reason. Let's take bonds first. The one thing about a bond is that if it doesn't default, you can predict very well exactly the rate of return that you're going to get. Today, for example, if you buy a 10-year US Treasury bond, you will get 3.88% return if you hold on to it until maturity. We know that we can predict, and we don't think the government is going to default. That rate of return is lower than the historical rate of return. Historically, when one looks at the numbers that were compiled by Roger Ibbotson, who you referred to earlier, the long run rate of return from bonds has been closer to 5%. So bonds are going to give you a lower rate of return than they did in the past. We know that, and I am willing to predict that. Nobody can predict what common stocks are going to give you, but there is one valuation metric that has been a reasonably reliable predictor, not of short-run returns. Nobody can predict short-run returns, but a reliable predictor of longer run rates of return. And that is the so-called CAPE ratio. What that is, and this goes back to historical earnings and what valuation metrics one should use. The CAPE is the cyclically adjusted price earnings multiple for the market. And the way you do the cyclical adjustment is you don't take last year's earnings, because next year's earnings may be lower, and the earnings before that were lower. You average the earnings over 10 years and take today's price versus the average earnings per share for the market over the past 10 years. Now, of all the things that predict 10-year rates of return, and this is all spelled out in the book, the CAPE is the best. It's far from perfect, even for 10-year rates of return. It explains 40% of the variation of 10-year rates of return. But what has typically happened is when the CAPE is well above average, you don't tend to get 9 or 10%, which is the long run rate of return for the stock market, but you tend to get more like 5 or 6%. And when the CAPE is below average, you don't tend to get the 9 or 10, but you usually get double-digit rates of return.
Mm-hmm.
CAPEs today are well above average. The market is not cheap. So that's one reason why. Is it perfect? Absolutely not. But it's one reason why people ought to be very cautious about predicting rates of return. The second reason why I think we ought to be cautious is, as I've said many times in this interview, I am worried that inflation is going to be stickier than it was in the past. I think we're going to have a terribly tough time getting inflation down to anywhere near 2%. The reasons are that I think we are going to have a perpetual labor shortage. The working age population is not growing. We're aging rapidly. The people who left the labor force in their late 60s and early 70s are not coming back. I think we're going to have wage pressures that are inflationary. And I very much worry about deglobalization. Globalization and being able to import cheap goods from abroad has tended to keep inflation down. We've now become deglobalists. We have become America firsters. This was started in the Trump administration, and we didn't like China in the Trump administration. And President Biden has doubled down on that. We still don't like China. We still want to favor American manufacturers. Deglobalization is going to be inflationary. So yes, I am concerned that we are going to have stagflationary tendencies over the next decade. Am I sure of this? Absolutely not. Nobody can be sure of this, but at least I think that's a possibility. I think we are going to see this in 2023. I don't know whether we're going to have a serious recession or not, but I think we are certainly not going to have rapid growth in 2023. My own guess is we'll have a mild recession. I don't know. Nobody knows. But we are not going to have rapid growth. I think we're going to continue to have inflation, and stagflation has not been good for common stocks. So for both reasons, my suggestion, and I put this specifically in the book, that one ought to think about maybe 5 or 6% rates of return that are more likely than the 9 or 10 that has been historically the case. Am I sure of this? Absolutely not. But I think prudence dictates that one ought to have modest expectations for returns over the next decade. Why? Because bond returns are well below normal, and because valuations are high, and we're likely to be in a stagflation environment, that stock returns are likely to be lower than the long run average.
Well, this has been wonderful information, partly from questions that I developed from reading your book, but I think I've mentioned in earlier, you actually answered a few of the readers that follow my emails questions, and I thought now might be a good time to open up 1 or 2 questions from our readers. And maybe Erica, if you would be so kind as to read those questions and let Bert take a crack at some of what our readers are interested in.
Absolutely. Thanks, Jim. So Burton, this first question comes from Andrew in Seattle, Washington. And he says, you've criticized the behavior of many CEOs and CFOs and called out a general culture of fraud and even embezzlement in the C-suite of many corporations. Do you think we need stricter enforcement of the security laws we already have, or do you think we need new laws?
Thanks, Erica. It's a very good question. And in certain areas, I do think we need new regulations. Whether it's new laws or new regulations, I'm not sure, but we certainly need more. And the cryptocurrency area is one that certainly comes to mind. It's been a Wild West, and when you've got a Wild West, it's much easier for people like the Sam Bankman-Frieds to essentially steal, and I would use the word steal, people's hard-earned money. So I think absolutely there are areas where we do need a stricter regulation. Having said that, though, let me, be a pessimist here, that however strict the regulations are, there are still people who will want to steal. There are still frauds that are going to exist. So however strong the regulation is, it's caveat emptor. It behooves all of us to continue to be on our guard and be very careful. And as I've said many times, always be very cautious of someone who is selling something to you who is out of breath, because it's such a wonderful opportunity.
Erica, do you want to do one more?
Sure, absolutely. This next question comes from David Kinnear in Maryland. And he says, what is your take on how the market has acted over the last 10 years compared to prior decades? With so much computer trading going on, pension funds, and the ultra-rich controlling so much of the market, does following the current and projected future cash flow still make sense as the best evaluation metric? It appears the market is being manipulated in short-term intervals. Too many times I've seen stocks beat on all metrics only to get crushed later.
I think there has been a change with all of the so-called algorithmic trading that has gone on. Does it mean that the old metrics no longer hold? Absolutely not. The old metrics still hold and hold with even greater force. What this has done, however, is to make the market far more volatile. I'm just amazed at how many times we've seen almost 1,000-point changes in the Dow Jones Industrial Average in a single day. This was not like it was 20 years ago or 30 years ago. Now, sure, the Dow Jones was lower, but even in percentage terms, the market is far more volatile. But as I've said, the dollar cost averaging investor can in fact benefit from this, because the more volatile the market is, the more the regular investor who puts money in regularly every week, every 2 weeks, every month, every quarter will benefit from being able to buy more shares when stocks are low. So I think this trading has clearly made the market more volatile, but I don't think the buy and hold investor will suffer from this. The regular investor can even benefit.
Well, that's starting to tie into, let's call it the very big picture. And you have said that there are so many bewildering claims about the stock market that it's important to have a book that sets the record straight. And I can't think of maybe anybody in America who is more credible than you to do that. Do you think that this 50th anniversary edition of A Random Walk Down Wall Street is that book to set the record straight?
I certainly hope so, Jim. I think what probably pleases me the most about having done this, I mean, I've certainly enjoyed teaching students. I've been a university administrator. I've worked in Washington. I've done a lot of things that were very interesting for me and I hope useful. But I think the thing that pleases me the most is receiving the multiple letters and emails from people who have said, you know, I followed your advice. I read the third edition 30 years ago. I read the sixth edition, 20, whatever it was. I followed your advice. I never had a very large income, but I find myself now financially stable and enjoying life. And I don't think from my own standpoint, there's anything with the exception of the love from my wife and family that pleases me more than receiving letters and notes and emails like that. So I certainly hope that it has done that. And at least from a lot of the letters I've received, it seems to have helped a lot of people.
And you have to consider, for every letter that you received, there were thousands and thousands who felt the same way, but never wrote. Just so, so we're talking about a book that has 2 million copies in print. And, you know, when I was looking for an introduction, I was going through, you know, best financial books in history, and in virtually every single category or every single listing, one of your editions or all of them of A Random Walk Down Wall Street appeared. And I think it's just so critical, particularly for young people, but also for older people, to say, okay, we have this wonderful author who for 50 years has been updating, I guess, 13 editions of A Random Walk Down Wall Street. And then you take the trouble at this stage of your life to come up with the 50th anniversary. It is a true testament to what you have done. And I could not even imagine a stronger recommendation for people to buy the book. And you wrote that one always hopes that one's professional activities have actually contributed to society's welfare. If the criteria for a useful advice book is, did it make a difference, then Random Walk has clearly passed the test. So I would say congratulations on that. It's, you know, just such a wonderful book that has so much both great general information and specific advice. And I would consider this your masterpiece and most valuable contribution to investors. And I'm just so thrilled that you've given me the opportunity to interview you and try to get some of your thoughts out into the investment world. Is there anything that we have not talked about, or is there any other message that you'd like to conclude this interview series with that would perhaps give our listeners and readers a little bit more wisdom?
Well, first of all, Jim, let me thank you. I mean, you have spent your life, and I know your books, which have been absolutely wonderful, and have given just enormously valuable tax advice for people. And I just thank you so much for the opportunity to be interviewed by you, and for the excellent questions that you and Erica have asked. So first of all, my deepest thanks to you. I would say, if I wanted to conclude with one thing, it would be, it's very unusual in a complicated field to know that the best advice is actually the simplest advice. That rather than making it all that complex, particularly for younger people, the idea that just save regularly, save in some tax advantaged way, and do it with a simple, low-cost, broad-based index fund. The fact that it's really very, very simple advice, and that often the simplest advice is the best advice. And let me end with that. And again, with my enormous thanks to you.
And my appreciation for everything that you've done and for these interview series. This will conclude the interview series. And again, thank you very much.
Thank you.
We hope you enjoyed this video. And as a thank you for watching, we're giving you an exclusive opportunity to receive a free book. That's right. If you purchase a digital or hardcover copy of A Random Walk Down Wall Street 50th Anniversary Edition by Burton Malkiel, we'll send you a free digital copy of James Lange's forthcoming book, Retire Secure for Professors. It's a wonderful book for professors, university staff, or anyone who has significant funds in their IRAs and retirement plans. And it features a foreword written by none other than Burton Malkiel himself. Just purchase your copy of A Random Walk from Amazon.com, Barnes & Noble, IndieBound, or one of the other many booksellers where it's available for purchase. And then visit paytaxeslater.com/random walk and complete the form to receive your free digital copy of Retire Secure for Professors. And as an additional bonus, the first 100 people to purchase either the ebook or the hardcover edition of A Random Walk and complete our form will also receive a free hardcover edition of Retire Secure for Professors as soon as it's available in print.